Welcome to the Explainer. Today, we're taking a hammer to one of the most pervasive and honestly most dangerous myths in modern finance right now. Everywhere you look, people are talking about using AI to trade the markets. But there is a massive fundamental difference between an AI that can write you a polite email and an AI that can accurately forecast market microstructure. I mean, with billions of dollars on the line, the distinction isn't just academic. It's literally the difference between having a calculated statistical edge and facing absolute financial ruin. So we're going to demystify exactly how AI is actually used in legitimate quantitative market prediction. Let's jump right in. Right off the bat, we've all seen this, right? You log onto Discord or Twitter and someone posts a screenshot of themselves asking a chatbot, "Hey, will Bitcoin go up in the next 4 hours?" And the chatbot spits out this highly fluent, plausible-sounding narrative that feels exactly like a trading signal. But here is the reality check. Relying on a large language model, an LLM, for live market prediction is exactly like asking a world-class sommelier to perform a clinical blood test. I mean, sure, you found a highly skilled professional, but you have handed them the completely wrong instrument. Okay, let's dive into this because the peer-reviewed evidence on this is actually incredibly sobering. In a recent paper titled The Wall Street Neophyte, researchers pointed a standard large language model directly at raw price data to see what would happen. The conversational AI was beaten by plain, old-school linear regression. Yeah, the basic statistical method you learn in introductory college math outperformed the most advanced text generation engine on the planet when it came to numerical forecasting. No way around it, that's a huge reality check. Now, what's really interesting about this slide is the core divide here. Large language models are legitimate miracles when it comes to textual synthesis. If you want to summarize a 300-page earnings call, extract sentiment from 10,000 news articles, or draft a research report, LLMs are unparalleled. They're amazing. But that is language. Short-term market prediction is not language. It's live microstructure and math. The moment your horizon shifts to predicting what an asset will do in the next hour, the inputs are no longer textual. They are purely numerical. To put a hard number on this limitation, we can look at the recent Faith benchmark, which tested intrinsic tabular hallucinations in finance. They found that even the most advanced frontier models, we're talking Claude Sonnet 4 and Gemini 2.5 Pro, exhibit a 10 to 20% error rate on multi-step numerical reasoning. Now, to put that into perspective, in a casual conversation, a 10% error rate is just a quirky hallucination, right? But in a live quantitative trading engine, missing a decimal or miscalculating a multi-step sequence 10 to 20% of the time is absolutely catastrophic. It's really crucial to understand why this happens, because it's not a bug, it's a core feature of their architecture. General-purpose LLMs are built on a decoder-only design. They are probabilistic next token predictors. They're designed to guess the next most logical word, not run continuous arithmetic engines. Plus, their training weights are frozen in time, meaning their knowledge of the market is instantly stale. They don't have default access to the live order book, and when they don't know an answer, they just hallucinate one that sounds perfectly confident. You simply cannot navigate live, shifting volatility regimes with an architecture built for writing essays. So, if chatbots aren't the answer, what is? Let's move into Section 1, Specialized Prediction Engines. We like to call this the instrument panel. If an LLM is like a junior analyst reading the news, a specialized market model acts like the trained instrument panel inside an aircraft cockpit, reading live, uninterrupted data. This is the heavy, completely non-textual data diet that quantitative models actually require to function in the real world. We're talking about structured, time-indexed arrays, OHLCV, which stands for Open, High, Low, Close Volume. We're looking at the limit order book, tracking micro-level order flow imbalances, queue depths, and liquidation cascades. Research consistently shows that in the sub-hour to 3-minute regime, it's this exact microstructural data, not news headlines, that actually drives price movement. And unlike testing a stochastic chatbot with a few prompts, specialized models require brutal discipline validation. You can't just test a model randomly across time. The industry standard requires strict chronological separation. It's a process called walk-forward validation. This ensures that the model is trained on the past, tested on the unseen future, and absolutely zero future data leaks back into the training set. It's totally crucial because it eliminates false look-ahead bias and proves the model's back-tested performance isn't just some statistical hallucination. Which brings us nicely to Section 2, the hybrid AI pipeline. Let's map out exactly how we get from raw data all the way to a final human decision. So the crucial point is how this pipeline literally steps through the process. Step 1 is live data ingestion. The system pulls in all that structured, raw market chaos, the OHLCV, funding rates, open interest. Then step 2 is feature engineering. This is where that raw data gets mathematically transformed to highlight things like order flow imbalance and the current volatility regime. Finally, step 3 is specialized model execution. A purely mathematical model, like a gradient-boosted tree, ingests these features and spits out a calibrated probability. Notice something? Up to this point, there is absolutely zero language involved. Let's move to and see how this builds into the back half of the pipeline. Now that we have a mathematical probability, step 4 introduces explainable AI to map out exactly which features drove that number. Then, in step 5, the large language model finally enters the chat. It translates that structured math into plain English. And finally, step 6. The human decision maker views this entire explainable package on a dashboard. I want to pause on that middle step for a second. Explainable AI, or XAI. Think of this as the dashboard's why. Using techniques like SHAP or explainable boosting machines, XAI opens up the black box. So instead of a system just randomly saying, Bitcoin will drop with 64% confidence, XAI actually tells the user, Bitcoin will drop, and here's exactly why. The current price structure is bearish, the volatility regime is highly unstable, and in the last 800 times we saw this exact setup, the market resolved downward 58% of the time. That transparency layer, it's everything. It stops the AI from being a dangerous black box. And this brilliantly illustrates the dynamic at play. The LLM serves as the newsroom, while the specialized quantitative model is the trading desk. The LLM never, ever invents the prediction. It doesn't generate the directional call. Its entire job is to sit downstream, consume the structured output from the explainable AI, and translate it into a human-readable narrative. Maybe it even adds in some recent macroeconomic context it grabbed from the news. But it is a translator, not a forecaster. So why does this architectural distinction matter so much? Well, welcome to the regulatory reality. Regulatory bodies like the SEC in the US and ESMA in Europe are actively cracking down on opaque AI. They strictly require that AI models used in finance be transparent, recorded, and auditable. The SEC has already levied massive civil penalties for AI washing, which is where firms make false claims about what their AI can actually do. Promoting a black box chatbot as a can't-lose trading signal, that's a massive red flag. The law demands explainability, plain and simple. And that leads us to this foundational truth. AI is a decision support tool. A properly built hybrid pipeline gives you a calibrated probability, an expected magnitude, and a confidence band. It gives you the historical context, but it never removes the human in the loop. The ultimate accountability for any financial decision remains strictly with the human operator looking at the dashboard. The buck stops with you. Which leaves us with this final, provocative thought to take away from our explainer today. As the financial world gets absolutely flooded with new tools and flashy interfaces, you have to look under the hood. When you see a fluent, convincing forecast pop up on your screen, you need to ask yourself, are you relying on an AI that was built to explain the market using language, or are you relying on an AI built to actually predict it using math? Knowing the difference isn't just an advantage anymore, it's an absolute necessity. Thanks so much for joining me, and I'll catch you on the next one.